Hi, welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Okenquist, Senior Research Analyst here at Dent Research. Joining me to take you around the world of economic and financial news and covering each topic in 2 minutes or less is the editor of Boom and Bust, Mr. Rodney Johnson. Rodney, how are you today?
I'm good, Dave. How are you?
I'm doing well. Very rainy here in Tampa, so it's just kind of huddled indoors, going over the news and connecting with you over the big stories, Rodney. And the big one that came out was this morning, actually. U.S. GDP expanded 2.1% in the second quarter, beating expectations. Just some stuff around the hood. Don't want to get too technical, but it was driven largely by consumer spending, which is the highest level since 2014. Also, government spending contributed to that as well, whether you can see that it's either a negative or a positive, depending on which side of the aisle you fall there. Some of the things dragging down GDP, though, was lower business investment as well as inventories. But looking at the first half of growth, we're at 2.6%, not too shabby. And then really, Rodney, I think the question I have for you is, does this change anything that the Fed is going to do next week, or how do they see this report?
I think they see it the way we do, which is it's kind of a modest report. 2.1% growth is actually just above the level of 2%, which used to point toward recession. And yet we've become kind of accustomed to 2% being the middle of the road. And so it's not great, but it's not terrible. I think it cements that the Fed will lower rates by 25 basis points. It takes the 50 basis point cut idea off the table. Mm-hmm. I'm still struggling with why they're doing anything because it seems kind of long preemptive, right? They're looking at the business side of this, which you mentioned is a little bit of a negative. I want to say it's the sixth consecutive quarter of decline, perhaps in residential investment, which would be housing, of course. And so there are some negatives there, but are they big enough to require the Federal Reserve to change monetary policy when we have higher incomes driving consumer spending? I don't really buy it, but I think that they're going to stick to that line of thinking.
Yeah, we saw, I believe it was minutes from maybe the last meeting or maybe two meetings past where the Fed sort of said how aggressive they were going to be this time coming around if there was a recession or a downturn compared to what happened in 2008. That response now. So are you suggesting, based on your comments, what you said, that maybe they're sort of what preemptive action before a downturn rather than being reactive, proactive?
Yeah, I think that's exactly what's going on. Their comments were from a conference they held in Chicago back in late spring, early summer, where they said, look, next time we're just going to step on it. None of this 25, 50 at a time. We're going to really hit it. Which implies they would be in the 50 to full basis point, full 1% move if something were to happen that was pretty ugly in the economy. But I think instead what we're seeing is they're saying, look, we're just going to ease down, hoping that we can keep the bubble inflated so this never happens. And like I said, whether they need to or not isn't really entering the conversation. It's all but baked in the cake where Jeremy Powell said they're going to do it.
Yeah. Well, Rodney, these are all just buttons and levers that you push, and you push a button and the economy does what you want, right? Isn't it that simple?
It's that simple. All we got to do is sit back and collect dividends and watch capital gains grow, right? This is great, right up until the day it doesn't. So
right, exactly. Some other news, Rodney, we got was on the housing side this week. We got new and existing home sales. Looking on the new home sales side, they were up 7% for the month and 4.5% for the year. And as you noted, that prices are starting to level out, but some good strength there on the new home side. However, on the existing home side, for the month and the year, down about 2% in the negative territory. So slacking there, although prices, I think you noted, rose as well. So Rodney, we've got we're sort of in the weeds here, month to month, week to week when these things come out. It seems like a pretty familiar story with housing. So I want to ask you sort of a different question. What would there be in the data? What sort of change would we need to see that this industry is either just going to continue strong or possibly roll over? So what do you kind of have your eye on?
Well, they're not strong. The interesting part is new home sales are now at 4.5% for the year, but they were up 7% last month. And so what that tells you is they were negative until last month. Mm-hmm. And so we have both new home sales and existing home sales sitting really just under zero for the year. And I know new home sales is right above, but it's just 1 month. And so will we see it come back? And so what that tells me is we're already in that flattening part of the curve where potentially we get this, rollover. And the rollover is going to come when you have lower sales and eventually prices start stepping down. Real estate prices don't move like stocks. They're not in arcs. They tend to be in stair steps. And so what will happen is if we have sales move lower in a meaningful way, not down a couple of percent year over year, but down 7, 8, 9%, then you're going to see sellers go, man, I have got to get in front of this. And they're going to have to start lowering prices in chunks. And remember, new home sales is about 10 or 11% of the market. Existing home sales, of course, is the rest, 89 to 90%. And so that's the 800-pound gorilla. That's what we want to watch. Prices have remained firm. I don't think that's going to be the case. I think if we're looking out 6 months to a year, you're going to see prices start to walk lower if we see sales start to walk lower. The mitigating factor in here is income, which has been rising. But is it rising fast enough to offset the fact that prices are so high? I just don't think we're there yet. I think we're still going to see sales drop a little bit, see prices come down, and then we're going to have this meeting in the middle between prices down and incomes up.
Now, as you noted, I think we talked maybe a couple of weeks ago, the direct relationship between the Federal Reserve interest rate, the main interest rate, and mortgage rates really aren't exactly the same. But is there anything here with the Fed lowering a little bit that could just bring mortgage rates down just a little bit more?
Absolutely. It's moving the curve. And it's not just the Fed. I mean, we have to, we're Americans, right? And so we are the most powerful nation on the planet, 6,000 nuclear tipped weapons and all that stuff. And of course, the largest economy. Well, there are other central banks around the world that make a difference. And there's now something like $11 trillion in negative yielding debt in Europe. It's just crazy, the numbers. And so what's going on is you're seeing a global retrenchment in interest rates from what was a low level to an incredibly low level. And so that pulls rates down around the world even further, including ours. And so the Fed lowering rates is something that's on the short end, but the long end of bonds where you price mortgages to, you're seeing that under pressure from the ECB, which made very dovish noises this week. You're seeing it with, the PBOC trying to be easier, the Bank of Japan continuing on its path. And so I think people who are getting mortgages are getting incredibly favorable rates that they would not if it was just based on the U.S.
Now, speaking of the ECB, they had an announcement that they're going to leave rates unchanged, and then hinting for either a rate cut or bond buying in September. And as you said, sort of how these things all interact. Now we've got the Fed lowering rates. So it seems like, does the ECB sort of have to play catch up in a sense where now they're going to have to lower?
They don't have to play catch up in the sense of they're trying to make sure they lockstep with the Fed. Their problems are more Eurocentric, where they have low inflation, hovering around 1%ish, and they're worried about it falling to deflation. They're watching their exports slow down, which is, something that comes out of the trade wars with the US and China. And they're seeing business activity slow down in general in GDP. And so they got a lot of things over there that are getting mushy and closing in on the zero number that worry them, which is why they would take these actions as a central bank. The Fed doesn't help. There's no question that the Fed doesn't help because it's all about the currency at that point. If we lower interest rates, then arguably the dollar is not worth as much because you can't earn as much on it when you make deposits in dollars. And so it means that our exports would be cheaper to the world competing with their exports, and we would have to pay more for their imports. And so they would want the euro to get a little bit cheaper to match up. That would be kind of the reason they would be looking to us and saying, hey, what are you doing here? But the euro is like 111 to the buck. I mean, it's not expensive by any stretch of the imagination for, people keeping score at home. It started at 118 to the dollar. I mean, the low these many years ago, back in the 90s, it did drop to around 82, 83, if I remember correctly, but it's been as high as 160 when I had the joy of going to Europe and paying that as a tourist. And so we've seen a big fluctuation. It's at a fairly cheap level right now. They just want to make sure it stays there.
Rodney, you wrote something in the digest this morning that kind of gave me a chuckle, where sort of characterizing Draghi and the ECB sort of playing coy about what to do next. Talk about that. Or they're looking around, hey, we're a central bank. Is there something we can do to help this?
Yeah, they essentially said, hey, we're not doing anything today. We're putting it to a working group.
Yeah.
And it's like, seriously, you're a central bank. You have two hammers, right?
Yeah.
You have interest rates and you have bond buying. Those are the two hammers. There are some other things, interest on long-term loans and different things that they could pull. But the two really big hammers, everybody knows what they are. And so the working group is going to come back and go, swing a hammer. There's nothing magic here. You're going to
Rodney,
lower rates from
we've
negative 40 basis points to an even lower number, right? An even further sub-zero number. And you're going to start buying $1 billion worth of bonds again, billions of dollars worth of bonds again, to bring rates even lower. So they put it to the working group. Everybody knows what the working group's going to say, and then they're going to do it most likely at their September meeting.
Yeah, well, there's a panel, there's a committee, we wrote some papers.
That's right. We went through the process. The process told us what to do. We're just following advice. Hey, that's our job.
Absolutely. That's what the experts say.
Yep.
Rodney, South Korea is going to install solar panels in an effort to generate clean and sustainable energy. Sounds great.
Yes.
However, they have to cut down 2 million trees to do it. Did you spot some kind of irony there? I know you saw this story during the week.
It just seems so odd when I read it. We're looking for renewable energy because we're worried about the planet and we're worried about greenhouse gases and climate change. And so we need to install solar panels. So they cleared 4,400 hectares. And of course, being Americans, we're not really good with the metric system. That's about just under 11,000 acres, which is roughly 17 square miles, or about 75% of Manhattan Island. And so they cleared all these trees to put in solar panels. It's like, the trees were a pretty good deal. What the officials are trying to do is move away from nuclear energy, which is kind of the big problem with renewable energy. Nuclear is the best green energy that we know of because it's very efficient and it's consistent. You can control it, doesn't worry about the sun shining or the wind blowing.
So we will just close with that. Just to let you know, next week we've got U.S. house price index, the jobs report on Friday, and of course we got the Fed meeting. They're going to most likely cut rates by 0.25%. If you got any questions, comments about the market or the economy, you could send those to tv@economyandmarkets.com. I do apologize for the technical difficulty, but we will be here back next week. For Rodney, I'm Dave Okenquist, and this has been Economy and Markets TV.